Imagine waking up one morning and checking your retirement account. The account you spent 20 years building, every paycheck, every bonus, every sacrifice, gone. Not down 10%, not down 50, gone. That is exactly what happened to thousands of Enron employees on December 2nd, 2001, when the company filed for the largest bankruptcy in American history. People watched their life savings disappear in real time, on live television, while the executives who caused it had already cashed out hundreds of millions of dollars. This is not a story about a bad quarter or a risky bet. This is the story of a company that was never real to begin with. A company built entirely on lies, arrogance, and one dangerous question no one dared to ask. What happens when an entire industry decides to stop looking at the truth? This is Enron. To understand how Enron fell, you first have to understand what made it feel unstoppable. It started in 1985 in Houston, Texas, not as a tech darling or a Wall Street phenomenon, but as something as unglamorous as it gets, a natural gas pipeline company. The merger of Houston Natural Gas and Internorth created Enron, and its first CEO, Kenneth Lay, had a simple enough business. Move gas from point A to point B, charge a fee, repeat. For a few years, that's all it was. But then the energy markets were deregulated, and Lay, and later a hard-charging Harvard MBA named Jeffrey Skilling, saw something that most people didn't. If energy could be traded like stocks and commodities, Enron didn't have to just move energy anymore. It could become the market itself. Skilling had a radical idea: transform Enron from a boring pipeline operator into a financial powerhouse, an energy trading company that would buy and sell gas, electricity, and eventually anything it could attach a contract to. Bandwidth, weather derivatives, even streaming video. The idea was genuinely brilliant, at least on paper, and for a while, it worked. Or at least it looked like it worked. By the late 1990s, Enron was the darling of the business world. Fortune magazine named it America's most innovative company, 6 years in a row. Analysts couldn't recommend it fast enough. The stock went from around $20 in the early 1990s to a peak of over $90 by $2,000. Its executives were on magazine covers. They gave speeches at Harvard. Skilling drove a Harley-Davidson. Lay dined with presidents. The company had over 20,000 employees. A gleaming headquarters in downtown Houston. Offices on nearly every continent. Enron wasn't just successful, it was a symbol. A story about American ingenuity reinventing an old industry. There was just one problem: almost none of it was real. And the people at the very top, they knew exactly what they were doing. Here's where the story gets complicated, but stay with me, because once you understand this next part, everything else clicks into place. It all starts with a simple question: how do you count money that you haven't received yet? Normal companies have a simple rule. You record revenue when you actually earn it. You complete a job, you get paid, you write it down. Simple. But in 1991, Jeffrey Skilling convinced the Securities and Exchange Commission to let Enron use something called mark-to-market accounting. Here's what that means in plain terms. Imagine Enron signs a contract to supply electricity to a city for the next 20 years. Under normal accounting, Enron records revenue each year as the payments come in. Under mark-to-market, Enron gets to estimate the total profit from that entire 20-year contract and record it all on day one. So the moment the ink dries on a deal, Enron books hundreds of millions, sometimes billions, of dollars in profit, even if not a single dollar has actually changed hands. Now here's the problem. Those projections were not independently verified. They were made internally, by Enron's own people. And over time, the numbers became increasingly optimistic, inflated to meet the targets Wall Street expected. If a new deal came in but the reality looked worse than projected, simple. Do another deal. Book more projected profits. Use today's imaginary revenue to hide yesterday's imaginary revenue. It was, in financial terms, a Ponzi scheme wrapped in legal accounting language. And here's the question that should keep you up at night. If this was technically legal, how many companies are doing something similar right now? Mark-to-market accounting could inflate revenues, but it couldn't hide debt. And Enron was drowning in it. What they did next was so audacious, so brazen, that even the people who discovered it could barely believe it was real. If you're watching this and thinking, how did nobody catch this earlier? That's exactly the right question. And the answer gets darker the deeper we go. Make sure you're subscribed to the Boardroom Files so you don't miss the next story. Now, back to Enron. Enter Andrew Fastow. Fastow was Enron's chief financial officer, a soft-spoken, meticulous man who became one of the most creative financial criminals in American history. His job was simple in theory: figure out what to do with all the debt Enron was accumulating, as its real business underperformed its fake numbers. The answer he came up with was breathtaking in its audacity. Fastow created a network of outside companies, called Special Purpose Entities, or SPEs, with names like LJM Cayman, Raptor, and Chuko. Yes, named after Star Wars characters. These companies existed for one reason: to absorb Enron's losses. Here's how it worked. When Enron had a bad asset, a money-losing investment, a failed deal, a liability it didn't want on its books, it would sell that asset to one of Fastow's shell companies. The debt disappeared from Enron's balance sheet. The financial statements looked clean, but here's the twist. Fastow controlled those shell companies. They weren't truly independent. In some cases, Enron guaranteed the losses itself, meaning the risk never actually left the building. It was accounting sleight of hand on an industrial scale. And Fastow wasn't just covering Enron's losses, he was personally pocketing tens of millions of dollars in management fees from the very entities he created to hide his employer's failures. By 2001, Enron had moved over $1 billion in debt off its official books. The board knew. Some of the auditors knew. Arthur Andersen, one of the most prestigious accounting firms in the world, signed off on it year after year. This is the part that made Enron more than just a corporate failure. It was a systemic failure. Every safeguard designed to protect investors, independent auditors, oversight boards, regulators, either missed it, ignored it, or looked the other way. And it might have worked. It might have gone on for years more if it weren't for one person, one employee, who decided she wasn't going to stay quiet. By the summer of 2001, cracks were beginning to show. The dot-com bubble had burst, energy markets were volatile, and a handful of people inside Enron were starting to ask questions that nobody wanted answered. One of them was Sharon Watkins. Watkins was a vice president in Enron's finance division, sharp, experienced, and deeply uncomfortable with what she was seeing. In August 2001, she did something that took extraordinary courage. She wrote a memo directly to Kenneth Lay. The memo was direct, blunt, almost prophetic. She warned Lay that Enron could implode in a wave of accounting scandals. She described the shell companies. She described the risks. She told the CEO of Enron, to his face in writing, that the company was built on a foundation that could not hold. Lay's response: he had lawyers review it. They found nothing actionable. Business continued. But the memo didn't stay internal. When investigators began circling months later, Watkins's document became the smoking gun that proved what prosecutors suspected: leadership knew. Which raises a question that no legal verdict ever fully answered. If the people at the top knew, and multiple people told them directly, why did it take so long for anyone outside to notice? Sharon Watkins didn't destroy Enron, but she proved its leaders couldn't claim ignorance. And in a court of law, that made all the difference. In October 2001, Enron reported a $618 million quarterly loss. That was the moment the dam broke. The SEC launched a formal investigation. Analysts began asking questions Enron couldn't answer. Credit rating agencies downgraded the company's debt to junk. Banks pulled their financing. And the stock, which had touched $90 just 1 year before, entered a freefall that stunned even the most cynical Wall Street veterans. $90, 60, 30, 10. Under $1, in 12 months, gone. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, the largest bankruptcy filing in United States history. Over 20,000 employees lost their jobs. Many had been encouraged, pressured even, to keep their retirement savings heavily invested in Enron stock. As employees, they were often barred from selling during the exact window when executives were quietly cashing out. Some lost everything: retirements, college funds, 20 years of work. Meanwhile, in the months before the collapse, Enron's top executives had collectively sold hundreds of millions of dollars worth of stock. They knew what was coming. Their employees did not. And what happened in the courtrooms that followed is where this story gets truly extraordinary. The criminal trials that followed were some of the most watched financial proceedings in American history. Andy Fastow, the architect of the Shell Company scheme, pleaded guilty to conspiracy charges and became the government's star witness. He was sentenced to 6 years in federal prison and surrendered tens of millions in assets. Jeffrey Skilling, the man who reimagined Enron as a trading empire and drove its culture of aggressive risk and financial manipulation, was convicted on 19 counts of fraud and conspiracy. He was sentenced to 24 years in federal prison, later reduced to 14 after lengthy legal battles, and was finally released in 2019. Kenneth Lay, the CEO who presided over it all and claimed he never knew the true extent of the fraud, was convicted on 6 counts of fraud and conspiracy in May 2006. He never served a single day. On July 5, 2006, just weeks after his conviction, Kenneth Lay died of a heart attack at his vacation home in Colorado. Under U.S. law, because he died before sentencing and before his appeal was resolved, his conviction was vacated. Legally, Kenneth Lay died an innocent man, and Arthur Andersen, the accounting giant that signed off on Enron's fraudulent books for years, was convicted of obstruction of justice for shredding documents during the federal investigation. The firm, which had employed 85,000 people worldwide, surrendered its CPA licenses. It ceased to exist. One of the big 5 accounting firms in the world. Destroyed. If you've made it this far, you already know this channel covers the stories that business schools either skip or sanitize. Subscribe to the Boardroom Files. We cover the scandals, the empires, and the decisions that actually shape the world, and leave a comment. Do you think Kenneth Lay really didn't know? The answer might surprise you. The Enron scandal didn't just destroy a company, it rewrote the rules. In 2002, Congress passed the Sarbanes-Oxley Act, the most significant overhaul of financial regulation since the Great Depression. CEOs and CFOs were now required to personally certify the accuracy of their financial statements. Obstruction of audits became a federal crime. New oversight boards were created for the accounting industry. Whistleblower protections were dramatically expanded. Much of what we take for granted today in corporate governance, the safeguards, the transparency requirements, the personal accountability of executives, exists in its current form because of what Enron did. And yet, the story of Enron isn't really about loopholes. It isn't really about accounting tricks or offshore shell companies. It's about something older and more dangerous. It's about what happens when a culture rewards confidence over competence. When looking successful becomes more important than being successful. When the question shifts from, are we actually profitable, to, can we make it look like we are? Enron's executives weren't uniquely evil. They were, in many ways, the product of a system that celebrated them. Right up until the moment it couldn't anymore. 20,000 people lost their jobs. Billions in retirement savings evaporated.
This is the Boardroom Files, where empires rise, scandals break, and the truth is always in the fine print.